Mr. Snyder, how's it going, sir?
Peachy.
Peachy. I don't know about peachy, but I'm all right. I don't know about peachy.
I get a lot of people off guard with that
That's a big word right there.
one.
We started the live. Yeah, well.
Well, good evening, everyone. I called over the Finance Committee meeting for the Northern Virginia Transportation Authority for Thursday, May 14. We currently lack a quorum, so we will just hear first the presentation, but we'll take the action on the item to require a vote. So the first item on the agenda is a very important presentation, and one in which I hope that after we hear tonight at some future authority meeting, you can present that as well. It's
You want to on the main agenda?
what's
You want it on the main agenda of the meeting in the future?
Yeah,
Okay.
Yeah.
I hear you.
the portfolio interest rate shock analysis, because I want the entire authority to be aware of those steps which we're taking
Okay.
to protect the investments in the assets. So I'll turn it over to Ms. Sen, the investment and debt manager. Thank you so much for your work.
Thank you, Chair Snyder. So we have stress tested the portfolio against the interest rate swings, and here's what we have found. So the first slide, as it shows, it's a portfolio positioning overview. This slide talks about that the portfolio is continuing to generate strong income while keeping risk at a manageable level. Duration is maintained at moderate level by balancing the interest rate sensitivity. We have diversified exposure across the different issuers, which is the securities. And we also are acquiring high-yielding securities. So the methodology that is used to evaluate the interest rate are based on the market value, and we'll look into that in the following slide. So this slide highlights the different shock scenarios and tests that were performed on the portfolio, ranging from plus minus 50 basis points to plus minus 300 basis points. The 300 basis point shock scenario is a severe stress test and is not viewed as a realistic outcome though. So it shows the below table or the chart.
Mr. Chairman, with all respect and at the risk of sounding really ignorant, I don't know what a shock analysis is. Can somebody tell me what that means?
It's a term we use in the investment world. It's basically, as Deb will go through, you take a look at what would happen to the portfolio if the market rose 300 basis points, which is 3%, or more likely 1%. And what will happen to the portfolio in that situation. So it kind of looks to the future. We use it for long-term revenue estimates as we, up until this week, the Feds might be lowering interest rates, but with the economic news that has gotten pushed down the calendar. So if we look at the interest rates may drop 2%, then this will tell us what the impact on the portfolio.
Got it. I understand. Thank you. Excuse me. Thank you, Mr. Chairman.
Yes, sir.
So this table is actually the stress test that was performed, ranging from plus 50 to plus 50 to plus 300 to minus 50 to minus 300. And you could see the base is actually what the portfolio was as of February 28. So it shows both the book yield as well as market yield. Now, under a buy and hold strategy, the book yield remains relatively stable. The market yield reflects the portfolio's economic value based on market conditions on that particular day. So, for example, at the end of February, the base yield or book yield was 4.44%, and the market yield was 3.92%, meaning the portfolio continues to earn approximately 4.44% as the securities are being held to maturity. The mark-to-market position as of June 30th captures the unrealized gains or losses based on current market prices at that point in time, and it's not the actual losses or gains.
Okay.
It also shows how the portfolio may react to interest rate changes. So from an interest rate sensitivity perspective, a 100 basis point move would change the market value by 2%, which is roughly about 45 million. So the next slide So the next slide is actually our focal shock scenario, where it shows 100 basis point, which is 1% rate shock scenario. Now, if interest rate rises by 100 basis point in this case, then there's a short-term decline in market value, and which is an unrealized loss, but the future income improves because the securities are invested at a higher yield. And conversely, if the interest rate falls by 100 basis points, the market value increases, creating an unrealized gain, but the future income declines temporarily because we are investing in a lower yield.
So we're good either way.
Based on the way we structured the portfolio, yes.
Okay.
We try to make it a heads we win, tails we lose kind of proposition.
That's what I'm hearing.
So regardless, the portfolio will still follow the market, but at a lower pace. So the chart here illustrates how the yield and market value has an impact under different rate shock scenarios. You can see how the market value are changing based on the rate shock, and the yield are all just changing up and down based on the rate shock scenarios. So the next slide is basically a key insight where it says price volatility does not affect the returns on current holding unless the securities are sold. Like Mike mentioned, the portfolio actually does not have an impact on major Fed headline. Instead, the laddered approach keeps us flexible, allowing us to lock in attractive yields over time by aligning to the safety, liquidity, and yield objective.
Okay.
So the next slide is actually the 4 types of bond market risk and how the portfolio is positioned to measure them. While all the fixed income portfolios are exposed to certain market risk, hence the portfolio needs to be structured with diversification, high quality holdings, and laddered maturity approach. And this would help limit the overall exposure and maintain stability across changing market conditions. So looking into the currency risk, as you can see that we do not hold any foreign currency. So the portfolio is fully USD denominated. The limited exposure is that the interest rate risk, the change in interest rate may actually temporarily create an impact on the market valuation. So the event risk, like that refers to unexpected events like economic downturns, geopolitical situations, or even a post on X for that matter.
Oh my God,
which
that's
is
so
out of our
bad.
control.
It's so true.
It does move the market.
I know it. That's just so good.
So the next would be the liquidity risk, which is almost limited to none because of the laddered maturity approach again, which provides an ongoing monthly cash flows and liquidity access. So credit risk, the portfolio only holds AA rated securities, so limiting to default risk exposure. Coming to sensitivity exposure, the call risk, which is managed through longer call protection and selective positioning that's closer to maturity. Reinvestment rate, again, in a declining rate environment, we may have to reinvest at a lower yield. Inflation risk can actually reduce the real returns over time, but again, through laddered maturity structure, that can help mitigate the risk. So with laddered approach is what you have in front of you, the chart that shows a 5-year maturity chart. And you could see, so it's ranging from May 26 to May 2031. And as of April 30, the portfolio is continuing to maintain strong yields in the mid-range of 4%, even with changing market conditions. And the portfolio benefited from investments made when interest rates were higher, helping us earn higher yields across the different market rates. So our next approach would be to place maturities on the gaps that we have, like August 28, December 20, October 28, and June 29. This, I conclude my presentation.
I don't, can you say that, Mr. Can you say that last? Place maturities on gaps.
Yeah, the gaps are these.
I know what the gaps are.
Mhm.
I don't understand that whole sentence.
Oh, so basically, when the reinvestment occurs, so for example, May 26, I have 20 million.
Okay.
So when this matures, I would take this money and try to put in the gap.
Got it, got it. Okay, I understand. Okay, thank you. May I ask you a question? So, Mr. Lungi, and obviously the geopolitical issues in the nation and the world impacts. So it was believed, or right, the president was pushing that the interest rates were lowered. And he was and they believed that if a new Fed chair that would happen. So do you now believe that no matter who the Fed chair is, that probably won't happen because of where the economy and market has gone? Is that what you're saying?
The economic data that was released this week, and we have a new chair who was favored by the president, who takes his seat tomorrow, kind of combines to making it very difficult for the Fed to reduce rates anytime soon.
Anytime soon. Interesting.
Now, that assumes that the trends that were published this week, higher unemployment, higher inflation, less job growth.
I thought the unemployment numbers were better than expected.
That was the week before.
Oh. All right.
It took a sudden, I think it shocked everybody that the numbers that came out this week started showing what folks have been predicting for a long time, that unemployment was going to go up. And the unemployment figure, surprising most economists, actually held steady to improved for about the last couple months, especially with tariffs. But business inventories are going down. You typically like to see business inventories growing a little bit because it means people are building, buying, and putting things aside, especially this time of year because inventories typically accelerate heading in over the summer, heading into the holiday season.
Okay.
A lot of retailers make essentially all of their profit during the holiday season.
Right. So okay.
That's why Black Friday's a thing.
That's what is the thing.
Okay. Great.
So
So
it is kind of an interesting dynamic that the Fed chair tomorrow, who clearly
was chosen for the purpose of lowering interest rates still may not be able to.
yes.
Okay. And what would happen if the Fed chair who takes his seat tomorrow, who was chosen to lower interest rate, did lower interest rates?
He can't do it alone. He's got to bring the rest of the Federal Open Market Committee along with him.
They're gonna be like, are you kidding me?
Yeah.
Okay, got you. Thank you.
It was a pretty heavy lift with inflation nudging 3% instead of below 2% anyway. But I think with the economic data we got this week,
It's not gonna happen. And you don't think it's gonna happen for a few months more, at least?
it might not happen this year. Where previously they were anticipating 2 rate cuts this year.
Okay. Huh. Okay. Okay. One more question. It's not possible that the unemployment rate going up to the degree that it has could all be because of Doge.
Well, Doge's work was completed months ago.
Well, no, with respect, Doge's work with Elon Musk was completely ago, but there's still Doge taking place, and there's also for our area, there's still the very real fear of a lot of large departments moving to other places, which would be a huge fall off in unemployment in this, including possibly even Quantico, which would be a nightmare for all of us, especially Jefferson. So Doge is still happening, but that cannot be the reason for that alone can't be the reason for the unemployment.
And I'm soothsaying at this point.
Okay.
You take a look at the AI announced layoffs that have happened in the last 2 weeks. Firms like Microsoft, who very seldom have laid off, they're putting out numbers in tens of thousands.
Because of AI.
They're attributing it to AI and the transition to AI. Part of that is restaffing. A lot of these companies are sensing they have a skill set that they don't need. And so there may be some additional hiring with a different skill set.
Gotcha. Yeah.
But we're basically seeing an industry transformation. But when corporations do this, 30 days notice on a layoff for a corporation is a long notice period.
Mhm.
So, and they've been announcing a lot of those this week. One of the very interesting things that often gets overlooked in employment data is the quits rate. It's the amount of number of people who are voluntarily quitting their jobs. And a healthy quits rate usually precedes a more robust economy because people typically quit to go to a better job.
Yeah.
So watching the quits rate has actually gone up a little bit. So it's really a mixed bag. It really is a mixed bag.
Quitting to go to different jobs to go to Canada.
They could be going to Canada. The quits rate actually doesn't, when you see the other employment news that we've seen, the quits rate usually drops dramatically. So it's noticeable not by its small increase, it's noticeable by the fact that it hasn't dropped. And this is
The information is just not, it's just not kind of information we've seen before. There's just a lot of confusion.
we have seen it before. It's a little unique. What surprises me is we normally see this data coming in a variety of measures that we track. And we've gone from pretty decent economic data to this week was, I don't want to be overly dramatic, but it was a bit of a click.
All right, thank you, Mr. Chairman.
And we're talking about data that was released Tuesday and Wednesday, so we're seeing it on Bloomberg. The articles on it are getting written now. So you'll see it in more of the traditional media
Gotcha.
coming out in the next couple of days.
Thank you.
So, are there any other questions about this analysis? And Chair Jefferson, if you want to be briefed on it, because you weren't able to be here earlier, if you want to be briefed on, I'm sure staff would do that.
Thank you.
For that, sure. So, and I think Chair Randall asked a question at the beginning, worthwhile just asking and answering again. Why are we doing this analysis?
It's basically, it informs our future projections. It also lets us know what market impact may happen. We will see it on a valuation level since we typically do not sell securities before maturity. So where Deb's presentation looks at it at a much more near timeline focus. If interest rates were to drop by 1%, you would see what she notes, but it would actually take maybe 2 years. But in that same time period, with the laddered portfolio approach by stretching out maturities over that 5-year horizon, we may actually be recovering while we're still feeling the pain from what happened, the reduction that happened a year earlier.
I sort of view it as an analysis of really trying to stay ahead of where we are, think ahead, and to try to prepare to the extent that we can, protecting the investments and the assets against various eventualities, which strikes me as good governance.
The last chart that was up there that had the risk balloons, I think is really the most, part of it is the most poignant thing. I mean, you don't have a portfolio without having risk. But I think we had positioned the portfolio through the investment portfolio policy and the other, the guidance from the Finance Committee and the authority. You can't manage it much better than what we're managing it.
Much appreciated, and I do think in the future, potentially some version of this ought to be presented to the overall authority, because I want everyone to be as up to date as possible on the financial aspects of what we're doing. So thanks very much.
Mr. Chairman, and Ms. Blackman, tonight, we could perhaps, because well, this is just a presentation, so we can find the time to put it on the main agenda. I mean, the agenda for the authority meeting to do the presentation there. Okay. We can find the time.
Thanks. Any other questions on this? Thanks again for the work. Much appreciated. So we've got some action items. First is draft meeting summary minutes from February. Any questions or comments on these minutes? Not only entertain a motion that they be approved.
So here, Chairman. Second.
Thank you. Any further discussion?
Aye.
And passes unanimously. The next item on the agenda is the revenue projection. Six. Mr. Longy.
Thank you. This is exciting. On the revenue projections, we take a look at the prior projections, 26 through 29, and then we add fiscal 30 and 31. This is in preparation for the upcoming 2-year update, which will be fiscal 30 and 31 through the 6-year program. The next item actually turns this into the amount of money that's available for private. We have dramatically, I think, increased the sophistication and the accuracy of our revenue estimates, mostly from Lou, who has brought regression analysis and a whole lot of other statistical functions that are in the staff report. She should actually be doing a breakdown of that, but she didn't want to. But we have been working for the last couple of months, actually about a year, on improving the revenue estimates. I think we're there. We don't formally change prior revenue estimates. We cope with any differences, in this case, in fiscal 30 and 31. And you have a couple of mechanisms that allow us to do that I'll go into more detail. So tonight's, we are basically saying that we will have $512 million in revenue for fiscal 30 and $527 million in fiscal 31. You see how that breaks out on the 30-70 split. The 30% goes to your jurisdictions. The $358 million and $369 million you will see appearing in the next item for the PAYGO calculation. With that, this is kind of the next step. If the committee wishes to make the recommendation, and we'll go through the board in June. But we need to establish the revenue in order to be able to establish.
So you seem to be pretty optimistic. Why?
It is 30 and 31.
Why?
We've examined the trends. We think we're there. We had talked previously about the previous revenue estimates having a recession baked in. I think, and again, recessions don't schedule themselves well for us. They typically span fiscal years versus being all in one fiscal year. I think we've accommodated all of that. We also, as we'll talk about in the PAYGO analysis, we do a taper in the out year of the revenue estimates. It doesn't show up here because that would kind of skew the revenue estimates. I want to be able to, in 30, I want to be able to look and say, we projected $512 million and see how close we have come to it. Our target is to estimate at revenue just a little below actual to give us a little bit of wiggle room, most importantly, so that when we get to 30 and 31, we don't say, hey, we told you were going to have $1, but you only have 95 cents. There's a lot in the economy. I think there's a lot of uncertainty in the economy that is being turned into kind of the sky is falling. And I think over the next 6 years, we're going to have some rainstorms. But America has always come out of those rainstorms.
Considering what we've seen about the discussion about federal jobs being moved out of here, does that support the kind of projections that you're making?
Something will backfill those jobs. The houses that federal employees are leaving are actually something's having a positive impact on grantor's tax, despite the fact that interest rates are still relatively high for the near-term history, but still relatively low for a 10 to 20-year history.
Yeah, I get on grantor's tax potentially because you have buying and selling kind of a situation there, but how about the regional sales tax? That seems optimistic.
It's trailing our estimates right now, but our estimates are not seasonally adjusted. We have typically been closing out sales tax at about a 1% to 2% above what our estimates are. And again, part of our revenue estimation process combined with the PAYGO is I like to keep the revenue estimate numbers separate from PAYGO. Because if we do have, let's say we have a major disruption in 29 and we miss our estimate by $50 million, what we will do then is look at our estimates in PAYGO for 32, 33 and use those to make sure that we have enough money to backfill promises made in 29. We also have, and a lot of this is actually in the PAYGO item. We also remember we have $120 million working capital reserve. We have a very robust ability to manage our outgoing cash flows. And we've got a $1.6 billion debt capacity. So if we did worst case scenario, we could do a short-term borrowing to get us over a bump, which gives me confidence to frankly be a little aggressive on the revenue estimates so that we can put as much money into transportation or allow you as much flexibility to put as much money in transportation as possible. I don't think we're ever going to miss our estimates by 120 million.
So there are a couple safety nets, if you will. First, as you mentioned, the 120 million working capital reserve, and the second one being how much in debt capacity?
1.6 billion. And that's probably a conservative number because frankly, we haven't done that analysis for about 3 years.
Questions, please.
I thought you said you were peachy. You don't sound that peachy. I'm gonna wait real quick.
I hope to get back there before the end of the meeting. Okay. All right. Sounds good. Any other questions on this item? All right. Next item.
Can I make a motion on this item?
Yeah.
I move the Finance Committee recommends the Northern Virginia Transportation Authority adopt the FY 2026 to FY 2031 revenue projections presented in Table 1 below. I should actually add Table 1 below at the May 14th MBTA Finance Committee meeting.
Second.
Aye.
Aye. Most item passes unanimously. Next item on the agenda.
And on this, I apologize for the blue sheet, but we do try to use the most up-to-date information as possible. And I think to recap the PAYGO, we are recommending for both fiscal 30 and 31 combined that for the 2-year update that you will be looking at project approvals for in July, that you have the capacity of $775.8 million. The PAYGO determination basically takes the revenue estimates that you just looked at, and we go through 14 additional calculations. What we are doing is we add in interest earnings, so we're relatively conservatively estimating that the portfolio is going to add an additional $110 million on top of the revenue, the regular revenue. Again, those are fairly conservative numbers because so far this fiscal year, Dev has managed the portfolio to an earning point of 77.226. So she knows it. But again, we built some flexibility in there because at some point there will be a swing in interest rates again. We do a fund balance adjustment, which is basically bringing in funds that project cancellations, those positive variances on the revenue estimates, et cetera, come cycling back in at that point. Then we make a series of estimates for things we know are going to happen, fund balance. At this point, we know that fund balance. We know it's going to change next year and keep going. It's kind of a moving target. But debt service payments, we know. The operating budget, we are making an estimate on. And again, this is an estimate 5-6 years down the road. So, and then the rest of the expenditures are basically expenditures that are, again, we're projecting 5-6 years down the road. The transaction update does include additional VRT work, as this one did. It gives us a lot of flexibility to move that program forward as well. You'll see that we have the taper factor / recession, and this is where we come up with a pure number and then give us, in this case, $51 million of flexibility. Now that taper, we take it out of circulation on a theoretical basis for 30-31, but it gets added back in as the numbers materialize. So if we come in at 50 million above revenue, that will automatically flow back in through the fund balance adjustment. I know this is a lot to absorb, but this number will marry up with the work our planning folks are doing, getting ready to make project recommendations. Tonight, you hear from the public. Those comments will go into the planning functions recommendations as well. There'll be, that will go to the Technical Advisory Committee, the PCAC and the PPC. PPC ultimately making recommendations to you as an authority on which projects. And what PAYGO does is basically say, through all that, you'll have $775 million, so almost $750 million to projects. Don't worry, it'll go fast. The projects come.
Mr. Chairman, may I ask a question?
Yes.
Mr. Longy, I may have misunderstood you. So I thought I heard you say when you first started talking that that some of this PAYGO money could be set aside for projects already in process if there's any cost overruns or anything, or would this just be used for new projects?
Just new projects.
Okay, thank you.
If a project, and we have that policy 30, that
Yeah.
They're not supposed to come back.
That's why I was asking.
but
Okay.
some projects have scaled their requests and been upfront with us saying, this isn't the whole cost, and we are coming back to you for more money. So if they come back in 30-31, and I believe you'll see some projects that fit that bill, this will be available for that.
Okay, thank you. Thank you.
And again, if you still have the working capital reserve, this doesn't include spending any of the working capital reserve and doesn't tap our debt capacity at all.
Okay.
So one could look at the tapering 21 million in some and 30 and 30 million in some and 31 is yet another sort of protection, if you will.
Yeah.
So if that money becomes available, then we add it into the money that's available for PAYGO. If it doesn't, then
But as you, when you adopted the 29-30 2-year pay-go, there was a taper there. Now that as we get, and like there was for 26, fiscal 26, when we see that that taper isn't utilized, it automatically comes back into the calculation via the fund balance adjustment. So it's kind of like a circular process. But if at any point in time, the taper needed to be used, then it doesn't cycle back into funding process.
all these practices are subject to the auditors, right? Yeah, and they were basically following practices which they've reviewed.
I mean, this does fall into where they look for management's judgment and they evaluate our judgment on this. And if they had a concern with our judgment, they certainly would bring it to the finance committee's attention as the audit.
We've not heard any challenge like that. So, okay, any questions? I'll entertain a motion for the action.
The Finance Committee recommend Northern Virginia Transportation Authority adopt the PAYGO budget recognition detailed in table 1 below at the May 14, 2026 NVTA Finance Committee meeting.
Second.
Thank you. Any discussion? All those in favor, signify by saying aye.
Aye.
Opposed, none, passes unanimous. We have some discussion information items on Ms. Sen and Mr. Longy, anything particularly focused on?
I don't think we have anything to add to the investment portfolio. We spent some time on that this evening. Like I said, the earnings so far are $77 million. If you would like, I can go through the other discussion.
The investment benchmark. You can see those benchmarks. Page 2, items.
I do give the common caveat, no matter what we do, the portfolio will follow the market. We just delay the following on the downside and try to speed up the improvement on the upside. And the other thing is the benchmarks obviously are also following the market. So
Provides the also provide where the investments are made by capital.
every security is listed in the appendix.
Okay. Anything else that either of you want to focus on? Staff, anything? Thank you again for almost appreciated. Okay, they've been important to this, but really important. Thank you. Does anyone have anything they want to bring up? The committee not on the agenda. I hear, yes.
We did, as we discussed earlier, we submitted the grants manual through
That's right. Yeah,
our auditors for review. They not only did an audit level review on it, but they also put their grant specialist on it, somebody who has experience managing grants for as a director of finance and a CFO in Virginia. And then we conveyed it to the council who gave us some feedback. I don't see any issues with the feedback that they've received, but they noted that since this is targeted to federal grants, there's a lot of references to the Code of Federal Regulation in there, and offered that it may be advisable to have somebody with a greater level of expertise with that take and review as well. If the committee agrees with that, we can do a cost projection and have a action item ready for the authority in June, because it would take authority approval.
Or July, just because of scheduling.
No, it'd be July.
Okay.
Yeah, oh, yeah. It'd be July.
I'm already committed to.
Well, that makes it easier on us.
Yeah, June's gonna be very hard we're gonna have a virtual meeting in June. Yeah, and it'll be a fairly quick virtual meeting in June. Yeah,
And I think, I mean, we're talking
I'll talk about that.
a cost of like $5,000 to $10,000. I really don't have an idea, but I don't think it's going to be an excessive cost. But if the committee wants to give me a directive, a verbal directive, I'll be more than happy to have that ready for July.
So the grants manual is used by whom and when?
I'm sorry?
The manual that we're talking about is used by whom and when?
It's used by the authority when we get a grant award that we are actually managing. So we envision that many of our grant applications will tie together a number of jurisdictions. One of the ones that we would have liked to have done is Prince William, Manassas, and Manassas Park has a trail by rail project that I think Fairfax and Arlington, Alexandria may look at joining that in the future. We thought that would make a much more compelling case if a regional authority submitted the application. But in that case, we would probably still look to Prince William to be the executor of it. So a lot of our applications will just be that, and they'll make it clear that we're applying as a regional entity, but we'll, at that point of the application, we would know which jurisdiction would actually do the grant execution, in which case we would just simply turn it over to them in all probability.
And so you clearly want to know all the state law elements to that. Appreciate the work of the councils on this and so many other things you help us with. But there may be federal money in some of these projects.
These would be federal grants.
Right, so you want to make sure that we're complying with federal, which suggests we should retain some expertise in federal grants law.
This is about expertise in federal grants law, or the new language that has to be included or not included to receive federal.
And then exactly what the requirements are for expending it, all the rest of it, which might differ from the state. So we want to make sure this grants manual covers both state and federal law.
Since equity is one of our core values, I'm not sure we're going to get any federal money.
But in case we do,
Just saying.
now I'm being optimistic.
Well, I will point out the manual hopefully will survive the administration.
So we'll have a cost estimate back at the next meeting.
So I can say I was peachy.
So we'll have a request for that funding back at the next meeting.
We, because of the virtual meeting for the authority, we somewhat anticipated canceling the June Finance Committee meeting.
Okay, so then it would be in July.
So if you're okay, if we wait till July, we don't have a meeting in August, and it won't be till September if the committee so chooses, I'd be more than happy to take a verbal directive to take it to the authority in July. Or I can come back to finance in July.
I think we're talking what amount of money?
It's got to be less than 20,000. I really don't have an idea.
To the full authority, I put like a finish in there.
Yeah, you do not want to slip up federal grants.
Yeah, you don't. You're right.
You're correct.
So. Yeah, if it's in that nature, I mean, as far as I'm concerned, does anybody object if that's brought to the authority the next
No.
in July? Yeah. Thank you, appreciate it. Thank you. Anything else? You don't get another one. No, just kidding.
Nope.
Well,
The revenue reports, revenues are doing okay. The operating budget is below projection. All budget lines are in order. So there's nothing negative to say about any of those.
Okay, thanks. Does anybody, let me ask again, does anybody have anything else who's up for an None? Okay, not saying anyone, I say a motion to adjourn.
so moved. Second.
Aye.
Left here.
You were talking.